Hello and welcome back to the Geordie Pig Investor channel. Today we're going to be going through, is Safestore Holdings PLC stock a buy right now? What is Safestore Holdings? Ticker symbol SAFE. Well, Safestore Holdings is a self-storage company. The firm have approximately 178 stores, comprising 125 solely owned in the UK. The remaining stores are mainly situated then across Spain, France, and the Netherlands. The firm provides storage to approximately 80,000 personal and business customers across all the regions I've just mentioned. Safestore Holdings is based in the United Kingdom, so it is one of our UK REITs, and it has a market cap of 1.6 billion. It went public in 2007, has over 650 employees, has a very nice dividend growth streak of 14 years, and actually has a massive 5-year dividend growth rate of over 15%, with an also very healthy dividend yield at 4.06%. Safestore's 1-year performance, as we can see on the chart, it has actually dropped over 25% in the last 12 months, which means that the price may be at somewhere that's in attractive range right now. What we're going to be finding out today is diving a little deeper into Safestore and seeing if it is a buy, sell, or hold right now. Safestore fundamental analysis. They have a positive cash flow of over 95 million. They have exceptional 3-year revenue growth at over 11%. They also have positive operating income at over 136 million. They have positive gross profit at over 154 million. They have a good ROE at over 11% as well. They have very low debt to equity at 0.4, which is very nice to see for a REIT, I may point out. They do only have average interest coverage, but it is still covered at a 5.5% rate. They have an average Altman Z score at just under 2. And they have a couple of good things and bad things here, where they have bad short-term solvency, which is as expected of a REIT, but they do actually have very good long-term solvency, which is the one that I would be more concerned about of the two. If I could pick for one of them to be in a good position and one to be in a bad, this is the way around that I'd have it, especially for a REIT. They do also have positive net income of 752 million. Moving on to the actual cash flow charts, we can see from the chart that Safestore has had very, very successful free cash flow and has been growing that number since 2013. The numbers are very, very impressive, and for a REIT that has to distribute over 90% of taxable income every year, this is a really good sign. Also, it shows from the graph that they actually increased their revenue over COVID, which this also leads nicely into the fact that if there is to be any uncertain events that come up, they can also still have proven to increase their dividend payments as well. So having that 14-year streak means that they have continued to increase their dividends throughout COVID, and I believe they will do so throughout a lot of different events that may come up. So they also only have a 67% payout ratio, which is a very low number for a REIT, and shows again that they should be able to comfortably continue to grow that dividend at a fantastic rate. So their numbers across here are really, really strong, and I'm just very, very impressed with their current free cash flow. Moving on to Safestore's discounted cash flow valuation. So by using the DCF model, this model is going to estimate the current value of a company based on projected future cash flows adjusted for the time value of money. The DCF valuation process calculates the present value of a company's forecasted cash flow based on selected operating models. You can see that Safestore's price right now is 740 GBX, and when we plugged in a discounted rate of 8.1% with a terminal growth of negative 2.8%, it came out of being overvalued at 56%, being worth 327 GBX. When we put in a discounted rate of 7.8% with a terminal growth rate of 0%, it came out of being overvalued at 24%, being worth 563 GBX. And when we put in a growth rate of 2.8% and a discounted rate of 7.3%, we can see that Safestore actually come in at being undervalued by 31%, being worth 1,079 GBX. So quite the range here of different scenarios and different numbers, and does really affect what the value of Safestore is. Hence why I don't just do this one example and don't just use the DCF model as my only way of valuing the stock. We also look into the relative valuation, and by looking into the relative valuation, we can then see what the intrinsic value is by adding the two together. I will then also get a third valuation from a different metric, which we will get onto soon. So what is relative valuation? Well, it's a method that's used to value a company by comparing it to other competitors based on certain metrics. The metrics it uses usually includes things such as EV to revenue, EV to EBITDA, and PE ratios. There's also plenty of other metrics you can use, but these are the main three that I personally stick to and have had a lot of success with over the years. The worst case scenario for Safestore when plugging in these numbers is an undervaluation of 36% being worth 1,152 GBX. Their average case scenario was being worth 1,312 GBX, which is an undervaluation of 44%. And their best case scenario was being undervalued at 49%, being worth 1,445 GBX. So as you can see, these three numbers all making it undervalued. And when comparing with their competitors, you can see that it is a very, very well valued company. So like I just mentioned, we're then going to be able to work out the intrinsic value from these values. And it's as simple as adding the two values together and dividing by 2. So as I mentioned earlier, Safestore's price is currently at £7.40, or also known as 740 GBX. Now the worst case scenario when adding the two together actually comes out at its exact price right now, which was 740 GBX. The average case scenario when adding the two together came out at 938 GBX. And the best case scenario came out at being worth 1,262 GBX. Moving on to my third valuation method that I like to use that I mentioned earlier is Wall Street estimates. The Wall Street estimates are an average estimate of a public company's quarterly earnings and revenues that lead to a valuation of that company. These numbers are forecasted by a company-specific analyst who provides research on that particular company and therefore comes up with what they believe is an accurate valuation. There are multiple analysts for the mid and large cap companies. Someone like Safestore, being one of the biggest REITs in the UK, would have multiple analysts going through on a daily basis and predicting these numbers. As a 1 year price target prediction for the worst case scenario, they decided it was worth 838 GBX, which is an 18% upside. On the average case, they believed it would be worth 1,000 GBX, which is a 35% upside. And on the best case scenario, they actually believed it would be worth 1,407 GBX, which was a 90% upside. So you can see that they're very bullish on this company across the board, across all analysts, when it comes to the Wall Street prices. So what does this mean? Well, overall, we can see that Safestore price, £7.40. And now that we have all three scenarios, I can add all three together and get the average across the three. So when adding these together, the worst case scenario came out of being worth £7.72. The average case being worth £9.58, and the best case being worth £13.10. So if you wanted to use a 10% margin of safety on the worst case price, you'd be looking to buy it around about £6.95. And if you use a 20% margin of safety on the worst case price, you'd be looking to buy it about £6.28. On the average case price, which is the one that I usually would go to for any of these mid to large cap companies, you'd be looking at using a 10% margin of safety on the £9.58, which would give you a buy price of £8.62. And if you use a 20% margin of safety on the average case price, you'd have a buy price of £7.66. On the best case scenario with a 10% margin of safety, you'd be looking to buy at £11.79. And with a 20% margin of safety, you'd be looking to buy at £10.48. Is Safestore Holding PLC stock a buy right now? I think that this is one of the most underrated UK REITs on the market right now. It's still showing some really strong numbers across the board, and I struggle to see why the stock price has dropped so much in the last 12 months. It actually had an even bigger drop a few months ago, which unfortunately I didn't look into the company back then and would have been at an even better buy price. It is still showcasing exceptional revenue growth with free cash flow numbers you could only dream of for most companies, never mind a REIT, and the crazy 5-year average dividend growth rate at over 15%, coupled with an already impressive 4% yield and that 14% of consistently raising the dividend, alongside a fairly low payout ratio for a REIT of only 64%, so it has plenty of room to grow, means this stock is absolutely a buy for me right now. I see it as not only being one of the best value stocks in the UK right now, but actually one of the best valued REITs in the entire world. Especially for us UK folk who don't have to pay any dividend tax on a UK dividend stocks, I believe that this is such an attractive price and you'll be reaping the rewards not only from the dividend but also some price appreciation over the next couple of years. To back this up further, looking through my valuations, it is comfortably in the buy range on my average case scenario for both a 10% and 20% margin of safety. What's your thoughts on it? Are you going to potentially open a position with them? Or have you already got a position with Safestore Holdings? Let me know in the comment section down below. I hope you enjoyed the video today. Please let me know of any other stocks you want to see a full breakdown on. Please like and subscribe. And this is the Geordie Pig Investor. Over and out.